Hey everyone, and happy Tuesday! Y'all know what day it is, right? It's Mortgage Tip Tuesday with It's Your Girl, hashtag JLoan in the building. That's right. I am coming at you. I have some great information and I hope that you'll like it, you'll comment, and you'll share. So right now in the US, the debt, the credit card debt, personal debt is over $1 trillion, okay? And this is higher than it has ever been, which leads me to believe that there's a lot of families that aren't doing so well and are leaning on credit cards to basically make it month to month or week to week. And there's also a lot of homeowners that have a ton of equity in their home, but they don't want to touch their 2% or their 3% or their 4% interest rates because interest rates are higher now than they have on their home loans. So the questions that I keep getting in my inbox is, should I refinance my house to take equity out? Should I do a HELOC or a home equity line of credit? What can I do to tap into the equity in my home? And most of the question is without touching their first mortgage interest rate. So I wanted to break the three options that are available for you to refinance, to tap into that equity, to consolidate debt, if that's something that you want to do. Or of course, seconds aren't just for consolidating debt. They're for home improvement projects. They're for paying for college. There's so many different things that you can do with taking the equity out of your home, which a lot of people have tons of equity in their homes right now, and they're just really scared to kind of tap into that. And what does it all entail? Okay, so the first option, which may not be the favorable one, but I have to ride the fence, right? The first one is you can do a cash out refinance of your first mortgage, which means we will pay off your current first mortgage, and then we will give you up to 80% of the value of your home, the rest of what's left, okay? So for easy numbers, if it's $100,000 of value, your maximum loan amount can't exceed $80,000, and let's just say you owe 50. That would just mean that the equity that you would get out would be obviously minus your closing costs, the $30,000. Okay, so that's one way that you can tap into it. And of course, what that does create is it creates a fixed interest rate mostly. It's still spread over whatever term you may want it, your 15, 20, or your 30 years, which is what most people are doing now, because the longer you spread out your mortgage, the lower your payment is. But it gives you that cash one time, okay? The reason why I still like this option is because if you don't want to do a mortgage at all, then your only options are to do personal loans. And personal loans are typically anywhere from 2 to 7 years. So again, you shorten the time period for the amount of money you want, which is going to make your payment higher. And from what I've seen on bankrate.com, those interest rates can be anywhere from 7.99% all the way to 35% APR. That's high. Okay, so where your mortgage interest rates are not that high, maybe it won't be a bad option to refinance your first. Okay, so that's one option. Obviously, anything you want to take a look at, we can run the numbers for you. We don't have to pull your credit right away. We could just run numbers and allow you to be very visual with it to make sure that you're making the right choice. Okay, the second option is a HELOC, or a home equity line of credit. And what that does is that creates a second mortgage. Okay, so we won't touch your first. It creates a second mortgage. And I like to look at HELOCs or compare them to having a credit card on your home. You can actually access that line and pull from that line until you reach the max. So the same scenario, if you're getting a $30,000 line of credit, you won't get it all at closing like you would if you refinanced your first mortgage. That line opens up and then you draw from it as you see fit to do what you need to do with it. And you can actually pay it back. And if you pay it back, it keeps that line open. Typically, not saying always, it's open for 10 years and you only have to pay interest-only payments on that for 10 years. And then after 10 years, it will convert into a regular principal and interest loan, unless obviously you refinance it down the road or you combine your first and your second because rates go down, whichever way you want to go, right? So that's one. The biggest thing I see with those is that most of them are adjustable rate mortgages. So most of those HELOCs are not fixed rates. So that may not be comfortable because you may not know what you're going to pay, right? But again, it does stay open. I do like that option. I personally have had a HELOC on our home and we did repairs and then we paid it off and the line stayed open. And then at 10 years, we just paid it off, right? But everybody doesn't have that option. And so you may need to refinance and do things of that sort. So your third option is that you can actually create a second mortgage. And it will give you that same equity, but right away, it gives you that cash, right away. So if it's $30,000, you get that, and you already begin paying principal and interest payments. So that would mean you pay a first mortgage. You'll also pay a full second mortgage as well with it, okay? So I hope that this helps you a little bit because, again, you don't always have to touch your first, but I also don't want you to just pay attention to the news or people in your ear stating that it's a bad time to do a cash out refinance. Because again, I just told you what personal loans are. Your home equity lines of credits, most of the time they're adjustable rate. So it may be a good option to consolidate all of your debt into one monthly payment. We have saved borrowers tons of money per month consolidating debt. And maybe it's something that you want to take a look into. If not, I've explained those two options. Either way, we only do first mortgages here, but if you're interested in any of the other two options and you're looking for a good HELOC or a second mortgage provider to help you with some cash out to help alleviate some of the stress associated with all the other debt that has higher interest rates, your credit cards and things of that sort. So if that's stressing you out and you got a ton of equity in your home, I say, why not? Like, let's do it. Again, you can only max out a loan of 80%, which does keep 20% equity in your home. Okay, so we're not maxing out and taking all of your equity and giving it to you. You're still protected. Okay, so if I can help you, let me know. 817-601-5456. As always, I hope this information was helpful. If it was, don't just like it, comment and share. Give it to someone else. Like I said, your neighbor could be struggling right now and they just, everybody's private when it comes to finances and you could help them. So again, it would make me super happy if you shared the video and hopefully we'll be able to help somebody. So again, it's your girl, #JLoan. Until next Tuesday, I hope you have a safe and a fantastic and a blessed rest of your week. Talk to you soon. Bye-bye.